Welcome to The Close. I'm Lindsay Biscaya in for Morella. Today, markets are closing in about half an hour from now. So first, let's get to some of the stories we're following in the BNN Bloomberg newsroom. Shares of Thomson Reuters are soaring today. The content and technology company says it reached 1 million professional users on its legal and business artificial intelligence tool. And it's working with Anthropic's Claude model. The Toronto-based company also mentioned it was working with OpenAI's ChatGPT and Google's Gemini. This is Reuters' biggest intraday gain since October of 2008. Canada's aviation regulator has certified the remaining Gulfstream private jet models. U.S. President Donald Trump had earlier said Ottawa had declined to approve the jets and had warned of tariffs and other retaliatory measures. Transport Canada has now approved Gulfstream's G700 and G800 models, and that's on top of the other two models mentioned by Trump last week. Gulfstream is a unit of American defense company General Dynamics. Bloomberg News is reporting Canadian generic drug manufacturer Apotex is looking at the first half of the year for an initial public offering, which could raise as much as $1 billion. An IPO of that size would be Canada's largest debut since 2021. The report says no final decisions have been made on the exact timing or size of the offering, and plans may still change. And FedEx has filed a lawsuit in a U.S. court seeking a refund for U.S. President Donald Trump's emergency tariffs. The transportation company did not provide the dollar value of the refund. Costco and cosmetics firm Revlon are some other companies also in tariff refund cases. More than $175 billion U.S. are subject to potential refunds after the U.S. Supreme Court overruled Donald Trump's tariffs on Friday. And we will take a quick look at the markets now. The TSX is climbing today up by 0.6% at the moment. It looks as though maybe we could reach another new record high for the TSX today. We will obviously keep an eye on that over the next half hour or so. If we take a look at U.S. markets, all trading up today. The Nasdaq in particular up almost a full percentage point at the moment. Canadian bank earnings started with a beat for Scotiabank, but valuations may be a concern for this sector going forward. And according to our next guest, for more on that and some other banks to consider instead, joining us now is Brad Radin, Portfolio Manager and Head of International Equities at Nicholas Wolff. And you're in studio. It's good to see you. Good to have you in.
Nice to see you.
Scotiabank beat estimates this morning. I'm wondering, first off, kind of your thoughts on that.
Yeah, it was a good quarter for Scotia. They pretty much beat across the board. Beat consensus, beat their year-over-year number, and all sectors were firing on all cylinders. Really, capital markets performed well, wealth management, traditional Canadian banking, and they also did a nice job on cost containment.
We've got the other big banks reporting, of course, over the next couple of days, the big five, at least in Canada. Are you expecting kind of similar results from them?
I think broadly similar. I mean, the banks are all fairly similar. They're different, of course, but fairly similar. I think the key things that investors will be watching will be credit quality. For any sort of sign that there's a deterioration in credit quality, Scotia had a slight deterioration, very slight, not sort of meaningful, but with bank stock investing, we always have to be hyper vigilant about credit quality issues. I think the other issue will be just underlying core growth in terms of the traditional Canadian banking business. It's fairly low growth, and will the banks be able to
keep that momentum going, kind of thing?
Momentum, yes.
Is it a good idea, do you think, for investors to be looking at Canadian banks right now and Canadian financial institutions as an investment?
They're very well-run companies. They're high quality. They're solid. They've got a nice moat around the business. The one kind of knock against them right now is they're fairly richly valued. Not ridiculously so, but about 30% above their 10-year kind of historic average. So at the expensive-ish end of things, but not ridiculously so.
You in particular, you like some international banks. So I'm really interested to hear about some of the ones that you have. Let's start with some Spanish banks that you like. Tell us about what you maybe prefer to go to?
Sure. So, I wanted to talk about these Spanish banks because clearly, being based in Canada, we hear a lot about the Canadian banks. Canadian banks had a great year last year, plus, 40%-ish on average. But there are many other banks around the world, and some of them have done really well. So a couple Spanish banks that I own, Banco Santander and BBVA, and the international stock fund that I run, and they had a fantastic year last year. They were up, triple digits and have been very, very strong, and are actually less expensive than the Canadian banks, and have sort of different avenues for growth. Santander is just putting a bid to buy Webster in the U.S., and both of these Spanish banks have a great amount of business in Latin America and the rest of Europe, and it really gives them some additional avenues of growth, and that's why we like the Spanish banks, and just are worth considering beyond the Canadian banks.
So you like the Spanish banks. There's also a couple of Japanese banks that you like as well. So tell me about the two picks that you have in terms of Japanese banks.
Sure. So I own a couple Japanese banks, MUFG and SMFG. They're the two largest banks in Japan. And the Japanese market has really been doing nicely over the last several years. And they've just elected a new prime minister who has a supermajority, is a very growth-oriented platform that she's promoting. And the Japanese banks have historically had exceptionally low net interest margins, just rock bottom, but they're building off of that. And there's a lot of room to still expand those margins. And that's going to drive some pretty solid growth over the next several years. And the valuation levels are slightly lower than the Canadian banks.
Interesting. Okay, so some good alternatives, I guess, for investors. Going back to some earnings reports that we've got this week, obviously all eyes on NVIDIA, or many eyes are on NVIDIA's earnings, which are coming out tomorrow night. What are your thoughts on what we could see? Is this an important quarter for the company, or do you think we'll see kind of more of the same when it comes to growth?
It's important in the markets right now in terms of the overall AI theme is clearly close to dominating everything right now. And there's a lot of push and pull right now with that theme, a ton of CapEx being spent. The interesting thing about NVIDIA is it has been flat for the last 4 or 5 months. It's kind of gone nowhere, despite being right in the, center of this market dominating theme. And the interesting thing is there are some other AI related companies that are kind of slightly peripheral that are still moving up tremendously. So some of my best picks last year were a couple of companies in South Korea, SK Hynix and Samsung Electronics, who both had triple-digit returns last year, feeding into the AI theme at lower valuations and better growth. They're focused in the memory space, and I guess my point is that that theme got so crowded in the U.S. that a lot of investors have started to look elsewhere for ways to play that AI theme.
And potentially why NVIDIA, as you say, there hasn't been much movement over the last couple of months. It's kind of stayed where it is.
There's a debate going on about whether this CapEx cycle is sustainable. I mean, $500 or $600 billion with the big companies in the U.S. on CapEx per year is an enormous amount of money, truly an enormous amount of money. And investors are concerned about whether those companies spending that kind of money will ever be able to generate a decent return from their investment in CapEx.
A lot to go over. That's all the time we have. Appreciate you coming in studio. Thanks for your time.
Thank you.
That was Brad Radin, Portfolio Manager and Head of International Equities at Nicholas Wealth. Well, coming up, Canadian drug maker Apotex is gearing up for a blockbuster IPO. We've got more on that when we come back. Stay with us. Bloomberg News is reporting Canadian generic drug manufacturer Apotex is looking at an IPO that could raise as much as $1 billion. An IPO of that size would be Canada's largest debut since 2021. So for more on this, we're going to bring in Bloomberg's Christine Dobby with the details. Christine, good to see you. So take us through the history of Apotex to start and how we kind of got to this point.
Hi, Lindsay. Good to see you too. Yes, so this is the company that was founded in 1974 by Barry Sherman, and he really did grow it into a generic drug powerhouse over the years. And Barry Sherman, viewers will no doubt remember, was, along with his wife, Honey Sherman, found dead in his home in 2017. That case, unfortunately, does remain unsolved to this day. But after that happened, the company was sold in 2023 to SK Capital, which is a New York-based investment firm that invests in life sciences companies. And so from that point is kind of how we've gotten to here. There's been some talks about when SK Capital would look to monetize some of its investment. And what my colleague Paula Sambo and I reported yesterday is that the company is indeed looking to do an IPO in the first half of this year and seeking to raise between $750 million and $1 billion.
Yeah, so if they go public at $1 billion Canadian, that would be the biggest IPO since 2021. Is that right? Like, who in 2021 are they trying to beat?
That's right. So in 2021, the most recent kind of largest IPO that we saw was Definity Financial Corp, the property and casualty insurer that raised about $1.6 billion. And since that time, there's really been a dearth of large IPOs, and we've in fact seen a lot of companies going private. You know, the large takeout of CI Financial last year, for example. And so there's really been a lack of companies, public companies, for institutional and retail investors to invest in. So I expect that this kind of offering could generate a lot of interest.
And does this hint, I wonder, at a possible resurgence for the TSX IPO markets, like more companies looking for an IPO?
I'm sure there's a lot of people who are hoping it does. And one of the things to look for is there are some other companies that are going to be testing the market in the next little while. One of those is Saskatchewan-based AGT Foods. They've already filed a prospectus, and they're seeking to raise about $250 million, if I'm correct. So people will be watching to see how that goes, and sort of how the pricing of this Apotex IPO will follow. This will sort of set some of the themes around that.
Okay, that is all the time we have. That's Bloomberg's Christine Dobby reporting for us. Very interesting stuff. Christine, thanks for that.
No problem.
Well, coming up, what does Trump's double down on tariffs mean for the Canadian economy? We've got more on that after the break. As the dust settles around U.S. President Donald Trump's new global tariffs, many countries are scrambling to figure out how the move will affect them. With Canada already a frequent tariff target, the new policy could be yet another blow to the trade relationship. And we got perspective from Julian Karagassian, lecturer in the Department of Economics at McGill University today.
In terms of direct impact, not a lot has changed. The sectoral tariffs on aluminum, on steel, on automobiles, on lumber, on wood products, those remain in place. But the upside of that pre-change in Supreme Court ruling, 90% of goods have been crossing the border over the past year, tariff-free, because they're covered by CUSMA, and that became quite clear last April. So 90% of the goods will continue, unless something else changes this week. 90% of goods shipped from Canada to the United States will continue to be exempt under CUSMA. So nothing really materially changes. Unfortunately, the sectoral tariffs remain in place.
And obviously, and that's the big concern. Just a quick question. You say 90%. Have more companies managed to find more things to qualify under CUSMA? Because I for some reason, I'm thinking of 86, like it was about 86. So people actually tried to step up and get more things to qualify?
It was, yes, or companies have just got their documentation ready for the U.S. Customs and Border Protection. So a lot of it had to do with documentation or the way that products were defined, because before, the free trade platform provided a lot of tariff-free access, and now a lot of documents are required. So companies have got up to speed on that.
And now with those sectoral tariffs that were being hit with steel, aluminum, could those face any challenges in court, like we saw with the Supreme Court ruling?
Well, they could, because the Supreme Court ruling was interesting. The House of Representatives and Congress generally is the body, is the part of government, the branch of the U.S. government that's responsible for raising revenues. So any revenue raising measure actually has to start in the House of Representatives. And the Supreme Court ruling last week affirmed that you can't put tariffs on to raise revenues. You can't regulate commerce with revenues. You have to use other measures. And so these sectoral tariffs that we face, the 25% on automobiles, the 50% on steel and aluminum, those are under Section 232 of U.S. trade law. And that part of the law invokes a threat to national security from importations from certain industries like automobiles or steel, or certain products. And so that has been invoked against us and against other countries. And the question is, do Canadian exports of, for example, aluminum threaten U.S. national security from an economic point of view? I'd say that that's something that can be very easily challenged in the Supreme Court if it were to be taken up there, because the United States doesn't produce a lot of aluminum. Canada is a larger producer than the United States.
Now, could you see that being challenged, or at least, and would the Canadians just want to kind of sit right now and figure out how to negotiate CUSMA with this latest Donald Trump?
I mean, Prime Minister Carney is a very strategic person. He's also very tactical. I don't think he would want to take that up now as head of the government of Canada while we're negotiating CUSMA, as you just suggested. If the CUSMA negotiations become extremely difficult or protracted, or if we have to walk away, if the Trump side demands too many concessions, then we could take that up with the U.S. Supreme Court. And it's interesting, last week's ruling, the court case was brought by 12 U.S. states, many of them Republican, and U.S. business. Many U.S. businesses brought that case.
And then bigger picture, I mean, we've been trying to get away. The government has been trying to move Canada away from the U.S. as a trading partner. Yeah. Is that working? And will any of this have an impact, do you think, on those CUSMA negotiations?
Well, I think it's working in the sense that, at the end of the day, it's people, businesses, and markets that conduct most trade. But the path of least resistance for Canada has been to trade mostly with the United States because of geography and language and so forth. So now we're having to make this extra effort to diversify our export markets. And before that happens, we have to lay the diplomatic and geopolitical foundations for that. And the Prime Minister has done that with the People's Republic of China. The conditions have been laid for a wider engagement. They called it a strategic partnership. And now with Mexico, with that immense delegation that the government of Canada went down with last week, including a provincial premier, we're laying the diplomatic foundations for a broadening of the relationship. Could that affect CUSMA? It could. It could make President Trump and his associates double down and say, you're not going to have these bilateral trade engagements, without our permission. But I think that we have to do that. It's in our long-term interest to spread our economic eggs in many baskets. Okay. And I don't see the U.S. trade uncertainty going away anytime soon.
That was Julian Karagassian, lecturer in the Department of Economics at McGill University. Well, the Canadian government is still urging travelers in Mexico or those who have plans to visit Mexico to remain extra cautious, even as the initial surge of cartel violence appears to be diminishing. CTV's Scott Hurst has the latest on the situation in Puerto Vallarta.
It has been an unnerving and unsettling 24 to 48 hours for many Canadian travelers caught in the middle of cartel violence in popular Mexican resort cities. But now with the Mexican government claiming a return to relative calm, flights to and from Canada are returning to cities like Puerto Vallarta.
We figure the Mexican government is very motivated to take care of the tourist industry, so I don't feel very worried.
Mexican authorities have deployed thousands of additional Army and National Guard troops to help restore order. The cartel violence sent shockwaves to the international community as, of course, many of the resort towns are popular with Canadian tourists. According to Foreign Affairs Minister Anita Anand, there are now roughly 55,000 Canadians registered in Mexico. But with an apparent return to more order, most of the major Canadian airlines flying into these popular beach destinations are getting back to a more normal flight schedule.
We have seen that there has been greater stability over the past 24 hours, in fact, so much so that Canadian airlines are resuming their flights. But it is very much a day-to-day point of consideration, and I would urge Canadians to take a decision on a day-to-day basis.
With popular travel weeks around March break quickly approaching, the Canadian government is advising travelers to register with Global Affairs should more violence flare up and be ready to reassess your travel plans on a day-by-day basis. Scott Hurst, CTV News, Toronto.
Well, payment processing firm Stripe is considering an acquisition of all or parts of PayPal Holdings. We're just learning this afternoon. This is according to people familiar with the matter. Stripe, which is privately held, has expressed preliminary interest in a potential acquisition of the digital payments company or its assets. A representative for Stripe declined to comment, and a representative for PayPal hasn't immediately responded to a request for comment yet. But you can see PayPal here. Shares of PayPal were up more than 8% today, currently up at about 6%. And we'll take a quick look at the markets before they close today. The TSX probably reaching a new high today. On February 17th, which was last week, the TSX reached 32,896 points. Now you can see it's above that, currently up also by 0.5%. So we'll be watching to see whether the TSX can make another move today into record high territory. Looks like it's going to happen, obviously. If we take a look at U.S. markets, all trading up today as well. We've got a rally in technology firms that's spurring a bit of a rebound in these stocks. The S&P 500 up 0.7%, same with the Dow Jones. And the NASDAQ, of course, if we're looking at tech stocks, currently up by more than a full percentage point. So it seems as though investors also bracing for those NVIDIA earnings, which are coming out tomorrow, and that could be pushing these stocks higher as well. Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. That's next. Here are the closing bells at the NASDAQ. MapLight Therapeutics is ringing the closing bell. At the New York Stock Exchange, Covista rings the closing bell. And at the TSX, Purpose Investments is closing the markets. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Streets. It looks as though the TSX did reach a new record high today, finishing the day almost at 34,000 points. So we'll continue to watch that this week. This is after it saw some momentum last week before dropping yesterday. S&P 500 also up to end the day. Same with the NASDAQ, up by more than a percentage point. If we take a look at some of the big market movers, particularly on the TSX, Thomson Reuters seeing its biggest intraday gain since 2008 today. This after it says it reached 1 million professional users on its legal and business artificial intelligence tool. It was one of the top performers. It was the top performer on the TSX today. We're also watching shares of Loblaw. It's one of the biggest laggers on the TSX today after reporting earnings yesterday and announcing billions of dollars in investments. It seems as though investors are a little bit cautious about that announcement. It's down today by almost 3% to end the day. And Advanced Micro Devices up today after announcing a deal to sell up to $60 billion worth of chips to Meta. We've been telling you about that, and we've got more on that in more detail coming up in just a moment, but finishing the day up almost 9%. And Intel elsewhere benefiting from the AI infrastructure momentum that we're seeing today. We see that in the U.S. markets as well. It's up to finish the day at almost 7%, up more than 6%. So joining me now for some of the movers south of the border is Bloomberg senior equities reporter Bailey Lipschultz to kind of break things down for us. It's good to see you, Bailey. Thanks for joining us. There you are.
Thanks for having me.
So let's start. You've got a couple of different stocks to go over here. We'll start with AMD. We, of course, have been talking about this a lot today, but let's give our viewers more details in terms of what's going on with this company.
Yeah, it's the news of the day and one of the best performers in pretty much any big U.S. equity benchmark. And coming after you mentioned that big partnership with kind of expanding kind of where it's able to sell its chips into, in this one coming in the form of Meta. So AMD having one of its best days in quite some time. This is making it more of a battle of two chip makers trying to combat the distance that NVIDIA has been able to establish in the AI game. So this coming as a huge contract, but also opening the door for Meta to take a pretty sizable investment in the company. Obviously, we've been talking for a number of months about these so-called circular deals, which are a bit concerning to some investors, just given that essentially AMD will sell its chips to Meta, which then can turn around and invest in the company, and it kind of goes around in a cycle. But when you're taking the bullish perspective, this is AI data center build out and, broadly speaking, AI investment infrastructure that is going to cost trillions of dollars over the next few years. So these are companies that are forced to make big bets. The bullish view is that the likes of Meta, Google, as well as a number of those other large companies like Amazon have the capacity to spend hundreds of billions of dollars on these types of investments. So when you look at the news from AMD, management obviously quite optimistic on the news. Investors dialing up some of their investments in the company, but obviously not near where it was earlier, or excuse me, at the end of last year. So still dealing with some of that volatility.
Okay, next up, is it Amer Sports? Amer Sports, they reported fourth quarter results, but their share down to end the day. Shares are down almost 5%. What's going on there?
Yeah, this was one of the worst days for the company since the fall. Amer makes really three main product categories. Wilson, so if you play tennis or football, you're familiar with the company. If you enjoy skiing, Solomon, as well as Arc'teryx, which is kind of that tactical gear. The main thing investors were nitpicking on was the fact that the company ramped up spending. So when the top line revenue beat expectations in the quarter, and management was pretty optimistic for the rest of the year. If you look under the surface and on that bottom line number, missing what some analysts were looking for, basically saying that they are ramping up advertising spend as it relates to Solomon, advertising spend as it relates to Arc'teryx. So two competitive categories in the skiing and kind of ski adjacent apparel, if you will, weighing on the expectations for the company, which really has been on quite a bit of a tear. Even if you look at it over the last 12 months, still up about 33%. So investors maybe taking some of their gains and pocketing them, or maybe just a little bit of uncertainty if the consumer globally does dial back spending, just given that Amer is so heavily tied to growth in China, what that could ultimately look like for the company. But it did seem like analysts and investors really calling out that SG&A spending.
And lastly, you're watching U.S. health insurers facing a probe by Medicare. What's happening there?
Probe by Medicare, and also just a lot of uncertainty around what this evening's State of the Union will look like. As you see right across the screen, Humana actually closing at its lowest level since November 2016. So pretty notable size and scope for that company. We also saw the likes of CVS and others under pressure. When we first saw the red on the screen this morning, we thought maybe it had to do with Novo Nordisk slashing the cost of their GLP-1. But actually talking to some investors, it's the Medicare probe. It's the potential impact of what compressed margins could mean from those GLP-1s, and more importantly, what could come from this evening's State of the Union address from President Donald Trump. Obviously, insurers and the middlemen have been in the crosshairs of the U.S. government for quite some time, so a lot of jitters around what may or may not pan out in this evening's kind of speech, as well as some of the commentary coming thereafter. So certainly an industry group to keep an eye on in tomorrow morning's trade for folks when they wake up and are looking at pre-market movement for the likes of companies listed here in New York.
Yes, it's going to be interesting to see the repercussions of that. Okay, we'll leave it there. That's Bloomberg's Bailey Lipschultz joining us live. Thanks for your time. Up next, we will look at Canadian bank earnings and investment ideas. We've got more on that after the break. Scotiabank kicked off Canadian bank results with an earnings beat. And for more on that and his investment strategy, joining us now is Philip Peterson, Chief Investment Strategist at IG Wealth Management. It's good to have you join us. Thanks so much.
Good to be here. Thank you.
So first of the big five banks to report today, Scotiabank, what do you make of what you saw in their earnings report to start?
Well, it was a strong report. I mean, you could see that they beat on a number of different metrics. The interesting thing is that the market had already built in really, really high expectations in terms of not only Scotia, but I think the rest of the banks as well. So that's why you're not seeing the market respond to what is we would argue, a pretty solid beat on both top and bottom line.
So do you think that's the same story for the rest of the banks then over the next couple of days? Like things are already kind of baked in, you're not going to see much market reaction?
That's exactly it. I mean, the biggest challenge with the banks isn't going to come from the earnings side, or it's going to come from the economic side. That's pretty solid. And we think with a steepening yield curve, the banks will continue to generate strong growth through 2026. But the challenge is in the valuation. It's that these high expectations are already priced in. If you're looking at the banks on a price to earnings basis or a price to book basis, they're trading near the higher end of the past 15 to 20 years. So there's not that much more upside other than what earnings are going to deliver. And again, a lot of that is already priced into these stocks at the moment.
Interesting. Okay, so let's take a wider look at the markets, the North American markets. Obviously, 2025, a year largely dominated by the Mag 7. Do you think we're seeing a bit more kind of breadth in the markets over 2026, or what sectors do you think might dominate, if any, in 2026?
Yeah, we're seeing a really interesting start to the year of 2026. So a couple things that we note. One, there are some themes that are rolling over into 2026, gold in particular, precious metals, and we're having base metals participate as well. So the materials sector continues to lead the rest of the TSX. But where we're seeing a bit of a rotation, both in Canada and in the United States, is away from the tech-heavy names into the, as we've been hearing about them, the asset-heavy names. And so if you look at the performance of the sectors on the TSX year to date, it's been materials followed by energy, and then you have utilities and staples. In the United States, it's quite similar. So what led last year isn't leading now. And in fact, if you look a little bit closer into the United States, we see about 30% of S&P 500 constituents trading lower or more than 20% off of their 52-week high. So you're getting, even though the market is flat, you have a good rotation from the more expensive names into cheaper names, keeping the S&P 500, like at that even level year to date. But underneath it, we're seeing better breadth and a healthier market overall.
Interesting. In terms of AI-related stocks in general, there's obviously been a lot of concern, it seems, from investors at the beginning of this year, particularly in terms of what other sectors AI might affect. What's your kind of further long-term outlook for how AI stocks are going to do this year?
Well, I think some of them are being overly punished. To assume that the cybersecurity stocks are no longer going to provide value going forward, I think is a huge mistake. To think that Microsoft doesn't have exceptional value in this company is a huge mistake. And yet it's trading cheaper on a trailing and forward basis than Coke, than McDonald's, than Yum Brands, than Walmart. And we would say, in what world does this make sense? And this is the challenge that we have right now. There are some really attractive opportunities starting to pop up in the technology sector that investors and active managers may want to take advantage of.
Let's talk a little bit more about your investment strategy for this year, because you say you've been preparing for kind of like a rotation out of the U.S. Is that right?
Exactly. Over the past year, pretty much since Liberation Day, back last April, we have shifted our portfolios to an overweight the rest of the world, if you want to think of it that way. So we've maintained an equal weight position into the United States, although we're starting to think that maybe we want to pare that back. But we've been overweight Canada, overweight international, and overweight emerging markets, because these are the areas that offer better margin of safety in terms of the price that you're paying, reasonable valuations, and yet comparable earnings growth to what you can find in the S&P 500.
Do you think that's what investors should be doing, looking more into like emerging markets instead?
Absolutely. If you think that the U.S. dollar has some weakness further ahead of itself, which we believe we do, and you want to favor greater valuation, then emerging markets that have been a stellar performer so far year to date, we think can continue through the remainder of the year.
Are your clients receptive to that idea? I mean, for some, it could be maybe a little anxiety-inducing if you've never invested in emerging markets before.
It can be, but it's funny. A lot of our clients are more willing to shift away from the U.S. And in fact, we would argue that our clients have a greater appetite to invest either domestically here in Canada or elsewhere outside of the United States, even though we want to keep a fair balance. We're not completely wholesale selling out of the United States, but we are trimming it back in favor of these other areas. So investors, we find right now, are very receptive to this broader international diversification rotation that we're seeing in the markets that are playing out.
You also say you favor equity over fixed income because the downside risks are small. How small are they?
Right. So what we do is we look at the probability of recession over the course of the next 12 months. So recessions tend to bring about the really capital destruction bear markets that we want to avoid. We don't see any material signs of recession over the course of the 12 months in front of us. We think that the recession risk is fairly low. And in the environment that we believe that we're transitioning to over the course of the next year, you tend to see an 85% probability to the upside for stocks, meaning 85% of the time you see a positive return out of stocks, whether that's U.S. stocks or Canadian stocks. So with yields where they are today, you can get better returns out of fixed income without taking on significant downside risk. Notwithstanding correction, we can get a correction at any point in time, but it's the bear markets that we want to be sensitive to. And we just don't see a high probability of a bear market emerging over the course of the next year.
Interesting stuff. We'll have to leave it there. Philip Peterson, Chief Investment Strategist at IG Wealth Management. Appreciate your time. Thank you.
Thank you.
Coming up, Novo Nordisk has announced they would dramatically reduce the cost of Wegovy and Ozempic starting in 2027. We will break down the impacts of that right after this. Novo Nordisk is planning to slash prices of Wegovy and Ozempic starting in 2027 in an effort to improve affordability. We sat down earlier with Evan Siegerman, Managing Director and Head of Healthcare Research at BMO Capital Markets, and he says today's price cut doesn't reflect a price war.
I think what's really important when you look at the announcement today around pricing, they're talking about the list price. And drug pricing in the United States is pretty convoluted. Most people don't pay the list price, or they don't realize the list price. That's kind of a starting point when it comes to negotiations. So what's happening here is by lowering the list price, they're able to reduce deductibles, co-insurances, co-pays that a patient with commercial insurance might have to pay so they can get access. It doesn't change the net price that Novo realizes when they sell, a Wegovy pen, for example. We confirmed that with the company. So we don't think this is a price war. It's a good headline to show that they're thinking about price. It should help out-of-pocket cost for some patients, but it doesn't change, their business model fundamentally in our view.
Just kind of on the side on that, any concerns that insurance companies will kind of absorb some of those reductions and the people will still end up paying?
TBD, there's a lot that goes into contracting. When a patient has a deductible, for example, say it's a $3,000 deductible before their insurance kicks in, they're paying the list price. So if the list price is $600 versus $1,000, they're only paying $600 to get that prescription. A lot of co-insurance is also a percentage of the list price, say 20, 30%. So if you lower the list price, you lower the co-insurance. So that should help. In terms of kind of the rebates and discounts, that's a different negotiation between Novo and the plans, kind of the payer. I doubt that that's going to change significantly, especially given what the company said about net pricing.
And was Trump a factor in this? He's been pushing to make healthcare more affordable and prescriptions more affordable. Is that playing a role?
Great question. So, explicitly, no, we confirmed this with the company that this wasn't part of the MFN deals that we saw back in November. But more broadly speaking, I think anything as it comes to drug price affordability, especially out-of-pocket costs, right? The administration in the United States talks a lot about the out-of-pocket costs for people with insurance. And if Novo is proactively doing something to fix that, I think that goes along the theme of what the administration is trying to achieve. So while it's not an explicit deal, kind of you need to do this, or we're going to, negotiating to have this done, it is along the lines of what the administration wants.
And is this maybe trying to rebrand a little bit? Because Big Pharma doesn't have the best image. Is this part of it too, you think?
Hard to say. I think kind of the rebranding of Big Pharma is a larger conversation and a more complex topic, right? There's a lot of, kind of thoughts that goes into it. And there's a lot of nuances, especially when you factor in kind of the influence of the PBMs and insurance companies. But I think that a headline like this definitely helps Novo's image, at least kind of on the margin.
And not coming until 27. So why wait till then? Why not come in earlier?
Because I think that it takes a lot of time to actually kind of implement changes just in the broader system. A lot of the contracts for 26 are already set, and it would maybe actually cause more kind of turmoil in terms of affordability and accessibility. And remember, the cash pay prices are really affordable. The Wegovy pill starts at $149 a month, so that's far below any of these new list prices.
And how are they doing in I mean, this is such a huge sector and such a huge business, the weight loss and obesity drugs. Are they still holding their own?
So if you go back a few weeks ago around 4Q earnings and 2026 guidance, Lilly had a much more positive outlook. They forecasted a lower net price reduction. In the United States, Novo had a poorer outlook for 2026. So we do see a bit of bifurcation. They're still selling a significant amount of, their products, whether it's Wegovy, the Wegovy pill, or Ozempic for diabetes. But I think that, it's not the explosive growth that we saw, in the past couple of years. The Wegovy pill, though, is doing very well, and script numbers really suggest that it could be tracking to be upwards of $1 billion, potentially $2 billion in sales this year alone.
And then CagriSema, what kind of an impact does that have, the results that we saw?
Great question. So CagriSema was supposed to be their answer to kind of a higher efficacy weight loss product, more akin to Lilly's Zepbound. And, the data disappointed. It was supposed to be shown to be non-inferior. It actually was inferior, so it produced less weight loss than Zepbound did at the same time point, which was 84 weeks. And it really puts a question mark into how Novo is going to compete with Zepbound, Lilly's retatrutide, kind of some higher efficacy products, because, Wegovy is a good product, but kind of at its peak, it's about 16% weight loss. CagriSema gets you into the 20s. But, some patients need more than that and need a good answer for something if Wegovy is not kind of going to work for them.
And do they have anything else in the pipeline, or are they going back to the drawing board with this?
Yes and yes. So they have other things in the pipeline. They're looking at a higher dose of Wegovy, so a 7.2 milligram that gets potentially better weight loss with just one product. They're looking at something called amycretin, an amylin targeting asset. But when it comes to the drawing board, I think that they may have to potentially acquire, push forward some of their earlier assets that are dual or triple agonists. But they definitely need more than just Wegovy or semaglutide in their portfolio.
That was Evan Siegerman, Managing Director and Head of Healthcare Research at BMO Capital Markets. Up next, Desjardins has released its financial results for the fiscal year of 2025, and we will break down those numbers for you when we come back. Stay with us. Desjardins has released its financial results for fiscal 2025, and so to break it all down with us is Denis Dubois, President and CEO of Desjardins Group. It's good to have you join us, sir. Thanks so much.
Thank you for the invitation.
So you saw a lot of strong growth in 2025. How do you plan to sustain this growth given some volatility that we're seeing in the markets and the economy, et cetera, in 2026?
So I guess what we've been able to achieve in 2025, as you look at the overall growth being at 11.2%, when we look at the revenues, I think we've shown last year our ability in a challenging context with a lot of uncertainty to be able to answer the needs of our members and clients throughout the country. So as we look forward in 2026, we see a context that will be along the same line. So we think we are well positioned to achieve similar growth as we look at 2026.
Got it. So Desjardins increasing contributions to community development, including the Good Spark Fund, housing initiatives, to name a few. How do you pick and choose which projects or regions receive that funding?
So what we do is we do have within our co-op-based credit unions that are located at the local level. And so they are the one that do select our board members. We have roughly 200 credit unions that are part of the group. So the board members of those credit union, Caisse Populaire, they are the one that will select based on the needs of the local communities, the different needs. And we're very proud of having last year alone put back in the communities $133 million in sponsorship donation. We also have Desjardins Foundation that is highly engaged. And at the group level, we also look at other causes where we believe, for example, within the property and casualty insurance sector or the life and health insurance sector, for a specific cause that do support what we're trying to achieve in those different businesses.
What metrics do you use to measure like the social impact of this?
So we do have our own survey that we do every year to measure the impact of what we do in the community, just to make sure that those actions are well perceived, I would say, within the community. So, and we have obviously also the privilege of having 2,200 board members within those guys, plus our employees and general manager that are spread out throughout the country. And we have 4 times a year a meeting with 500 of those people where we do also take their feedback on how things are going in the field. So we have different measures that we use just to make sure that those investments back in the communities do create the right impact at the end of the day.
Also, right now, obviously, in response to the housing crisis that Canada finds itself in, Desjardins is stepping up its commitment. The goal is to create more than 10,000 housing units by 2028. That's quite an ambitious goal. So how do you scale partnerships and financing to try to reach that within that timeline?
So we started our initiative back in 2022, and it took a few years to get our approach developed, and so with obviously the provincial and federal governments, with also different partners, cities at the local level, having those people working together. And we really saw traction with the team that was created, their network, the approach in 2025. And we're very pleased at the end of 2025 to already have either built or in the process of being built 5,000 of those housing apartment being underway. And with what's already worked on, honestly, we feel very positive that we can have an impact or get to that target of 10,000 by 2028. And a lot of it was done in Quebec, and today we're looking to expand what was done in other provinces, including Ontario.
Okay, just the one last thing we can get to here is the launch of Cyber Suite Plus for small and medium enterprises. Can you tell us a little bit more about what that is and kind of what that entails?
Yeah, so we do have a property and casualty insurance product within our organization. So, and we do offer commercial insurance. So obviously those small companies do feel the pain of going to a cyber attack. And so we wanted to make sure that we have a product to provide the right support if they do feel the pain of a cyber attack. So this was an updated and refreshed product that was launched. And obviously that is very relevant to those small and medium companies today.
Obviously, digital protection is important, but how do you balance that with the need of cost pressures that many small businesses are facing?
So, in fact, we've been, as an organization at Desjardins, being so committed to develop digital protection for first the organization and at the same time for our members and clients. So we do have within the group what is called the Desjardins Protection that do provide different tools to our members and clients to avoid getting into the situation of being either hack or fraud. So that provide, for example, alerts. There's also, if there's a theft, identity theft protection that is provided. So we do have those tools that have been developed and that they are evolving over time just to make sure that we provide those tools to our members and clients to avoid those situations. But at the same time, that risk do occur, and so make sure insurance is there if they're not able to protect themselves.
Okay, a lot to go over. That's all the time we have. Denis Dubois, President and CEO of Desjardins Group. Appreciate your time today. Thanks for joining us.
Thank you.
Up next, traders on the Kalshi and Poly market are wagering on everything. We'll take a closer look at this emerging market right after the break. Stay with us. Traders on Kalshi and Poly market are wagering on everything from championship games to Fed press conferences. Critics call it unregulated gambling. For more on today's Big Take, we were joined earlier by Bloomberg's Christopher Beam.
Prediction markets have been around actually for a couple centuries, depending how you define them. People bet on elections as far back as the early 19th century, and some scholars have said that those markets were actually quite accurate in predicting the outcome of elections. But what we now think of as modern day prediction markets have really been around for a couple decades. Mostly they focused on elections starting in the late 80s and 90s. But now, if you go onto Poly market, Kalshi, you can see anything from elections to sports to betting on the Oscars or even on the weather tomorrow.
And how do they work? Do they just build up information and because they can process it so fast?
So the way it works is any given person, you, me, can go on to one of these platforms and place a bet on a particular market. And the market is framed as a yes or no question. So one of the better known markets out there right now is, will Jesus return in 2026?
And what are the odds?
And if you believe the answer is yes, you can buy a contract, and you're matched up with me if I believe the answer is no. And whoever wins that bet gets $1. And you were just asking what are the odds. I think the odds right now are quite low, but last week or the week before they were as high as 5%.
Wow, and so do you need someone to take your bet, or can you bet against the company or whatever who's providing the service?
So what the prediction market companies emphasize is this is peer-to-peer. So if you want to bet yes, the platform will match you with someone who wants to bet no. Or if they can't find someone who wants to bet no right away, they have market makers. They have companies that come in and match those bets and essentially hold those contracts until they can find a buyer. But fundamentally, what happens is if you bet yes and I bet no, and a million other people also bet, that will set a price. And say the price for Jesus coming back is 5 cents. That means people think the odds are roughly 5% that will happen this year. And so that's why people call them prediction markets.
And so obviously people are making money on it. Is this taxable? How are regulators handling this?
So the regulation is very much up in the air right now. In the US, the CFTC technically regulates derivatives markets, and the prediction market products are technically, they're called event contracts, which are a form of derivative. So they fall under CFTC jurisdiction. However, there's a whole slew of court cases that are playing out right now where state gambling regulators are suing Kalshi and in some cases Poly market, arguing that this is not trading of derivatives, it's actually gambling and should therefore be regulated by the state. And long story short, the states would treat prediction markets much more strictly than the CFTC does right now.
And of course, this raises the question, can we call it insider trading? Is that what it is, market manipulation?
Well, it depends on the case, but at the very least, it introduces this whole new debate over how to define insider trading. So, when it comes to stocks, when it comes to other forms of heavily regulated financial products, there's a long history of the SEC and CFTC deciding what is and is not insider trading. When it comes to prediction markets, it's a lot less clear. For example, if you're betting on what Trump will say in the State of the Union tonight, and some Trump staffer decides to participate in that market. Is that insider trading? Well, there's no rule that Trump can't tell one of his staffers what he's going to say. And so these are all questions that are so far unresolved, and a lot of people think the CFTC needs to be more clear on its definitions.
And have we seen cases? Have people been accused of this?
Absolutely. The best known case that you might have heard of is there was a market on Polymarket where people could bet on whether the U.S. would invade Venezuela and President Nicolas Maduro would be captured. And there was one account that bet a large amount and made about $400,000 betting that Maduro would be captured on a particular day. And we don't know who that person was, but in a case like that, I mean, that was on Polymarket, which is overseas and unregulated. But if that were on a market that was based in the U.S. and regulated, the platform would refer that case to the CFTC and they would launch an investigation.
That was Bloomberg's Christopher Beam. Up next, as stability returns to Mexico, we will speak with an expert who says she's constructive on the peso and the country's fixed income assets. More on that in a moment. Welcome back. Our next guest remains constructive on Mexican assets despite the recent violence in the country, saying the nation offers some of the highest real yields in emerging markets. Let's bring in Hadiza Jaitau, VP and Portfolio Manager at Mackenzie Investments. It's good to have you join us. Thanks so much.
Thanks for having me.
So it's been interesting to see market reaction, Mexican market reaction to what's been happening over the last couple of days. Despite this violence that's kind of ensued, why do you think markets haven't really been reacting that much?
Because I think it is actually very constructive. When you look at this operation that is one of the most significant in past years against narcotics and cartels, it is really a big departure with this new government led by Claudia Sheinbaum and kind of in opposition with AMLO, the predecessor president, who was more trying to address, let's say, root cause of crime by increasing allocation to household and families versus having direct militarized confrontation with cartels. In this case, we also see a stronger cooperation with the U.S. because the U.S. were also U.S. intelligence was part of the operation, and that really set the stage really well for Mexico ahead of the USMCA renegotiation.
So do you think Mexico is now prepared to maybe take further action against drug cartels to satisfy Donald Trump ahead of the CUSMA renegotiations that are happening this summer?
Absolutely. And I think Mexico has been very consistent in delivering on ask from the new administration in the U.S. Another good example was late in 2025, they agreed to increase tariffs on Chinese goods, like broad tariffs across a certain category of goods, because one of the things that the U.S. administration is looking for is limit the access of Chinese goods coming through Mexico into the U.S. And this administration in Mexico is really determined to be able to deliver what the president is asking so that they can really secure the USMCA. Let's remember that 85% of export from Mexico towards the US are under USMCA, and that really protects us from a term of trade perspective.
Obviously, we're seeing these global tariffs imposed by Donald Trump, 10% U.S. administration working to get that up to 15%. How do you assess the impact of these latest tariffs on the Mexican economy?
Very limited. The increase and somewhat the struck down of the IEEPA tariffs were actually not really impactful for Mexico because, again, Mexico had 85% of their tariffs excluded from the IEEPA. Now, when you look at the breakdown, I think the big uncertainty is on sectoral tariffs, especially on steel. We know how much Mexico imports steel in the U.S., and I think the direction that the administration in the U.S. is going to take in terms of maybe expanding Section 301, which is the one that can be prolonged after 122, which is a subject obviously of 150 days to get approved by Congress. It's really the directionality that we're looking for. Mexico has been very compliant and very cooperative with the U.S., and I would expect that to continue. And that's also very interesting when we look at Canada. Canada has decided somewhat to take a different stance when it comes to negotiating, and ahead of the USMCA review, I still remain very, very bullish on Mexican assets compared to Canadian assets in particular.
Very interesting. When it comes to Mexico as kind of an emerging market for a lot of investors, what sectors of the Mexican economy do you think have the most potential for growth in 2026?
I think AI, expansion of data centers, for instance, is going to be another tailwind for Mexico. I think export of commodities, the search for commodities and the bid on commodities has been significant. I think is going to continue. Mexico is one of the largest silver exporter. That is going to continue, obviously. Also cars. There is a lot of diversification, actually, when we look at the breakdown of the Mexican economy. Tourism is going to be impacted by the recent event. Let's be realistic about it. But when we look at the GDP breakdown again, Mexico's GDP accounts for about 9% on tourism, maybe 15% when you account for an indirect effects. But I will expect that to be manageable because there are other drivers for growth going forward, and commodity would be a big one.
Just very, very quickly, you have a constructive outlook on Mexican bonds as well. Why is that?
Because first of all, they offer a very attractive all-in yield. You can get 7% for short-term maturity. I do think that the central bank is really willing to cut rates further. They have started the easing cycle. Inflation has come back within their target. They have communicated very consistently that the real policy rate is still too high in Mexico and it needs to come down. And I would think that they will likely cut rates again in March, which would be supportive not only for local bonds, but also somewhat from the currency, because the currency, again, is going to get tailwind from flow of assets. We know this narrative around diversification away from U.S. equities, for instance. If you look at Mexican equities, they performed out 30% last year versus 16% for S&P 500. And I believe that that performance and outperformance of Mexican equities will continue and will drive flows towards the asset class.
Okay, Hadiza Jaitau, VP and Portfolio Manager at Mackenzie Investments. So good to have you join us. Thank you.
Thanks for having me.
And now it's time for Hot Picks. We zeroed in on 3 plays in media and entertainment stocks with Jason Bazinet, Managing Director of Media and Entertainment Research at Citi.
Consumers are increasingly wanting to go out and see their favorite artists in person. And so the concert business has been growing, very comfortably in the double-digit pace now for quite some time. And we don't see any evidence that that's going to end. The thing that's exciting about Live Nation is they're about in the 3rd year of, I'd call it backward integrating into more venue ownership, which carries much higher margins. And so this company used to spend $200 million a year on CapEx. For the last couple of years, it's been over $1 billion. And that's a very good thing because their returns on invested capital are at record levels. And we just want them to keep spending money. When they spend the money and they own the venue, they just get much higher margins because they get site lease fees. They control the food and beverage at the venue. They get sponsorship revenues. And so it's a very favorable mix shift.
And just tell us, so they've been on a real estate buying spree?
Yeah, they've been acquiring venues outright. They've been building some from scratch. They've been deploying capital to renovate older venues and give them a refresh. One of the big assets they just bought was a sports complex in Paris, and they're retrofitting it so it can handle concerts. And so it's a very exciting time for Live Nation.
And apparently they're so, you talked about hospitality, which would include beverage sales. Apparently, I hope I'm not out of date. I'm looking at a 2024 story. Apparently, you could buy a can of liquid death water, the exclusive water vendor at hundreds of Live Nation venues for $7 US. And Live Nation has had an ownership stake in that water brand for quite a few years. So they make money in all kinds of ways.
That's absolutely true. I mean, at their amphitheaters, the average fan is probably spending, $45 to $50 on merchandise, food and beverage. So there's just an insatiable appetite on the part of consumers. Live Nation used to call themselves, an accidental retailer, where, you'd get a warm beer and a cold slice of pizza. And they've been, radically upgrading sort of their offerings to appeal to consumers that are willing to spend, more money to get something that's better. And to your point about liquid death, I mean, there's clearly a push for consumers to be a bit more healthy than they were in the past. And so they don't just sell alcoholic drinks, but they also sell water.
Tell us about AppLovin. To my understanding, this company makes it easier to create your own video game.
Yeah, it's not so much create your own video game. Their customers, their core customers, about 90% of revenues are the video game, mobile game customers themselves that are looking for installs. And so they can go choose to spend their user acquisition money on their own, or they can choose to do it through AppLovin. And AppLovin has some AI tools that can put the right ad in front of the right person.
Oh, I see.
To make the user acquisition spend more effective for the mobile game publisher. In very short order, AppLovin has gone from an AI winner to an AI loser, which is why the stock is down. But this company, continues to put up, 70+% growth. They've done that for the last 4 years. Where the stock is trading right now, even with that very healthy top line growth, it's trading at a high teens multiple of next year's free cash with no debt. I mean, it's just absolutely on sale.
Right. And that's interesting. So the app developers are the ones it's aimed at, not so much the consumers.
That's exactly right. So the way it works is the mobile game publisher sends AppLovin, says, I want to spend some money, and AppLovin and goes out and buys mobile game inventory on behalf of the publisher. And then AppLovin gets paid if the consumer actually downloads the game.
And then your, excuse me, your final idea here, also video games, Take-Two Interactive.
Yeah, I mean, we've got Grand Theft Auto 6 coming out in November. That sort of consensus, I wouldn't say we're variant there. The really interesting thing that I'm focused on is on the balance sheet. They have a line item they call capitalized software development costs, which is essentially cash that they've spent developing games that have not yet been released. That number used to be a few $100 million. It sits at $2.2 billion. And my hunch is that there's a game that where the company has spent the cash but not yet released it and therefore not amortized it.
Oh.
That is Grand Theft Auto, but I think it's something else. And I think that something else might be a Red Dead reboot, which came out almost a decade ago. And so what I'm excited about for the stock is not just the Grand Theft Auto release in November, but potentially a Red Dead release maybe the year after.
What is Red Dead? What sort of a game is that?
Oh, it's like an open world Western. That's the way to think about it. So, you'd ride a horse and you have a gun and you walk around. And it's considered by video game aficionados as, maybe the most realistic open world game that's out there, even more so than Grand Theft Auto.
Oh, my goodness. And I guess we're just in the Stone Age. Games are going to get more and more immersive, aren't they?
Yeah, I think they are. I mean, that's what's very interesting. The market right now is just looking at all of these AI tools and viewing it as just a negative across the board. The market's painting with sort of a broad brush. I would argue that a lot of these tools are going to be used to lower the cost of development for a lot of these publishers. Mm-hmm. I mean, going back to AppLovin, if you let's say you take the maximalist, AI view, which says AI can just create games, at low cost, everywhere for everyone. What's really going to happen is user acquisition prowess is going to be at a premium, right? This is why the mobile game companies spend so much. They spend 30% of their revenue acquiring users. Why? Because it's so easy to make a mobile game. So if you believe in AI and you think it's going to be really easy to make a game, that should redound to the benefit of a company like AppLovin that specializes in user acquisition.
Because the cost as games become more complex, the cost of creating them has soared.
Yeah, that's right. So AI will make it, I think you'll have more games, cheaper games. There'll be a proliferation of games out there. And then having user acquisition, acumen, which is what AppLovin does, should be at a premium. Because at the end of the day, you need to get an install, right? It's not enough just to have some fancy graphics on a screen, which is what Jim and I and others, are rolling out. It's like, how are you actually going to get users? And that's hard, and it takes a long time.
That was Jason Bezinet, Managing Director of Media and Entertainment Research at Citi. Well, thanks for watching us today on The Close. We'll see you tomorrow.